All right, everybody. Good morning. Happy Wednesday. Middle of the week already. Happy Wednesday, hump day, and let's get after it. Today I am going to touch on a well-publicized ATTOM, ATTOM report on Q2 results. And the title of the article is Home Mortgage Lending Rebounds Nationwide with across-the-board gains in the second quarter of 2024. I put the link in the show notes down below, so if you want to check out the article, you can. Later today, I'll post a LinkedIn article summarizing it with full links. But here's just the top line heading. Residential loans surged 23% quarterly, climbing back to levels from a year earlier. Purchase, refinance, and home equity lending all increased. Despite shift, lending activity is still nearly 2/3 off the peak of 2021. So the good news is significant gains quarter over quarter. The results are fairly flat year over year, and of course we're significantly down from the peak. That's the bottom line. Now we're gonna live in the gain here for a while, and then I'm gonna end in the gap. And if you guys have read the gain and the gap, you know what I'm talking about. I've highlighted it before. But the gain, quarter over quarter gains, really big gains. So here's the thing, let's set the table. In Q2 2024, the industry we did 1.62 million units, 1.62 million units. And that's a 23.2% increase over Q1. So that's a giant increase, right? Almost a quarter. Now it still left lending down year over year, but just by 1.6%, so barely. So barely down year over year in units. You'll see that it's flat in dollars, but barely down in units. But like we said, it's 61% drop from the peak of 2021. But what's most importantly, it's the first gain, first quarter over quarter increase in over a year. So it's a really, really good sign. Good sign that quarter over quarter and month over month are starting to improve. Really good sign. And we're almost year over year improvements, right? So purchase activity jumped 32%, 32.7% Q1 over Q2 with about 783,000 purchase units. Refinance deals rose by 10.3% quarter over quarter to about 546,000 units. And then lines of credit shot up almost 27% to nearly 286,000 units. So here's what I want you to pay attention to. 783,000 units equals about 48.5% of the total volume. 546,000 refi units equals about 33.8% of the total unit volume. And 286,000 HELOC units equals about 17% of the overall units. So keep in mind, purchase is 48% of the unit volume. Refi is about 34%, and HELOCs are 17%. So there you go. And if you put it into dollars worth, if we step away, go to dollars instead of units, the industry funded $533 billion in mortgages in Q2, and that was up 27.6% from Q1, and it was up 1.1% from the second quarter of last year. So as we said, units slightly down year over year, but volume with higher loan amounts are slightly up. So let's keep looking at this. As we start to look at this, total units, we said they were at 1.615 million residential mortgages in the second quarter. That was up from 1.3 million in the first quarter, so up significantly, but down just slightly from the year before. Just slightly from the year before. The total, by the way, the year before was 533 billion for Q2, and we did, or 532.7. We did 533, so a little bit more. That's great. All good news there. Now, the largest quarterly increases came from Boulder, Colorado. This is quarter over quarter increases. Boulder, Colorado was up 106%, so 2x, 106% quarter over quarter. Honolulu up 100%. Appleton, Wisconsin, up 63%. Sioux Falls, up 56%. And Champaign, Illinois, up 54%. Now, for large metros, San Jose was up 46%. Minneapolis, up 43% or 44%. By the way, Minneapolis is on fire from a mortgage perspective. You're going to see it's up on refi too. Indianapolis was up 42%, and Boston was up 35%. There's only a handful of metros that were down, especially metros with any volume. The metros that were down quarter over quarter was Pensacola, Florida, down 19%, Buffalo, New York, down 16%, Atlantic City, down 2.4%, and Springfield, Illinois, down 1.7%. So that was the only negatives, quarter over quarter. Now, year over year, largest declines in total lending among population of at least 1 million. San Antonio was down year over year 19%. St. Louis, Missouri was down 15%. Austin, Texas down 14%. Dallas, Texas down 11%, and Buffalo down 11%. Those are year-over-year numbers. So Texas, and some points up in New York are having a little difficult time with the year-over-year numbers and quarter-over-quarter, but it's okay because 95% of the country is doing well. All right, so let's talk about specific types. So the second quarter purchase loan total of $782,937 was up from only 590,000 purchases the first quarter. That's up significantly, right? And dollar volume was $300 billion versus $223 billion. So really significant there. Super positive sign, right? But the total purchases were off about 7% from the year before. The year before we did almost 842,000 versus the 782,000. So we still have work to go in purchases. However, in a dollar amount, it was only off 2%. We're only 2% trailing. As a matter of fact, if the trend keeps continuing, we should start outproducing year-over-year results, right? Which the largest increases, by the way, year-over-year, were in Wichita. This is for purchase loans. The largest increases in purchase loans was Wichita, up 183%. Wow. Boulder, Colorado was up 148% in year-over-year purchase loans. Honolulu was up 143% in year-over-year purchase loans. Indianapolis up 86%. Fort Wayne up 82%. So all good. All really, really good. So now, here's the next thing. If you were paying attention to the percentages, purchase loans accounted for 48.5% of the overall unit volume from Q2. And surprisingly, that's up from the prior quarter because Q1, the purchases only represented 45%. Isn't that interesting? And we're going to talk about that in just a little bit, by the way. Now, if we're going to talk about quarter over quarter refis, regionally speaking, the biggest increases quarter over quarter in refis were, number one was Honolulu, up 70%. Let me get the rest of these numbers for you guys. Sioux Falls was up 55%. Boulder, Colorado was up 55%. Champaign, Illinois is up 53%. And Appleton, Wisconsin up 50%. So those are all up a quarter over quarter refis. Isn't that interesting? And if you look at it from people with the metros with at least 1 million people, it was Providence up 29%, Minneapolis up 24%, Detroit up 24%, Kansas City up 23%. So really, really good numbers. Now, let's look up HELOCs really quickly, and then I'm going to talk about a couple other statistics, but then I'm going to get into the gap instead of the gain. All right, so with HELOCs increased going from 226,000 in the first quarter to 286,000 in the second quarter. They're roughly even from the year before, although HELOC volume is up. It's up from when it's 53 billion Q2 versus 42 billion Q1, so up quite a bit, and nearly flat from a year ago. So that's HELOCs. The areas doing the most HELOCs, the most increases in HELOCs are Rochester did 50% more, Detroit did 50% more, Minneapolis did 40% more, Milwaukee did 40% more, and Grand Rapids did 40% more, roughly. FHA and VA loans were actually down. This is significant because it's the first quarter in 10 quarters that hasn't seen an increase. So it's the first quarter in 2.5 years where you see a quarter over quarter decrease. Not a really big amount, by the way. If you look at VA loans, they accounted for 13.9% of all residential loans in the second quarter. That was down from 16.4%. So there you go. And a dollar-wise, it's not that big a jump. If you look at VA loans, they were 5.1% Q2, down from 5.4% in Q1. So there you go. Now, some quick data on average loan amounts and down payments, and then I want to challenge everybody and get into the gap, not the gain. So going into average loan amounts, the average loan amount climbed to $368,207. $368,207. That's up 7.2%, for the prior quarter and 8.4% for the prior year. So average loan amounts are up 8.4% year over year. That's great news. That's really, really good news. Now, interestingly, the average median down payment is also up. It went up to 11.1%, or about $24,250, although it was slightly down from a year earlier. So the average, it's up quarter over quarter, but down year over year. But average down payments are going up. So there you go. Average loan amounts are going up. Average down payments are going up. So here's what we got. All good. All that stuff is in the game. Let's talk about the gap just for a second, if you would. 48% of business is purchase business. And I'm guessing almost everybody who's listening to this has at least 48% purchase business. But the thing I want to challenge you, does that mean that you have 52% of refi or equity business? Do you? Is 1/3 of your book today refi? And if 1/3 of your book today isn't refi, then you're most likely not a lender for life. You are not a lender for life. If you aren't servicing the average amount of your clients who need a refi, right, then you have a defect in your origination platform if you claim to be a lender for life, and you need to fix it. You need to get under the hood and go, what am I doing? I'm not capturing 33.8% of my refi business. Why? What am I doing wrong, right? And don't beat yourself up, because we know, right, statistics show that loan officers are only successful in retaining about 18% of their clients that they refi. That number is lower for past clients to go out and purchase, but for refis, loan officers retain about 18% of their past clients. Not great, but if you're between 18 and 33, you have opportunity to get better. If you're below 18, that means you're below the average. Like, you really are not a lender for life. Right? And then how about on these HELOCs? Is 17% of your business HELOC? And if not, why? Because if it's not, that means your past clients are going to a competitor, which doesn't seem like a good strategy to me. Personally, I would do HELOCs for free all day long to retain my client. I would service my client. I would strengthen the relationship, but I would talk about HELOCs all the time. And it's a chicken mark on the board. It counts as a unit. So just look at your book, look at your last quarter, see what you did. What percentage of purchase were you? What percentage of refi were you? What percentage of HELOCs were you? And see, is there a way to adjust that you might be able to capture more business? Or is there any truth that is reflected in those numbers? The same goes for companies. Companies have to look at the same thing. As a matter of fact, you know what I'm going to do? Tomorrow is my new normal series. It's on Thursdays. And tomorrow I'm going to talk about what companies need to do to retain clients in the future. I'm going to use a whole bunch of resources. I'll probably just opine quite a bit. But are we positioned as, lenders or loan officers, are we positioned to retain our clients? And if not, what can we do? So we'll talk about those type of things. That's it. Good news, though. Love to share good news. Living the game. The game is the good news. All sorts of good stuff. Try to, profit from the gap. What can we do better to increase our business? That's it. Hope you have a great day. I look forward to seeing you tomorrow. Thanks. Bye.